last 1.5 years. We have Venugopal Mangat, who's a Chief Investment Officer, Equity at HSBC Asset Management. Venugopal, great to have you with us here. Good morning. Thanks very much for your time here on CNBC TV 18. Venugopal, talk to us about what's the overall thinking and strategy about managing portfolios right now. We had Akash Prakash 2 days back in the Business Standard who wrote an article saying it's a pretty tough thing right now to be a portfolio manager with valuations where they are. It's not a new problem. It's been there around for a while. But just wanted your sense to kick the conversation off, and then we can dive into some of the specific areas.
Sure. I think that's right. The valuations have been on the higher side for some time now, but the good thing is that the economy is on the roll. And the markets are tracking those fundamentals. We are expecting a good growth for the economy over the next few years. And with all the tailwinds that are there, with the structural reforms that have taken place over the last few years, I think it's not wrong to really expect a reasonable performance from the markets over the next few years. So to that extent, I think one has to live with slightly higher valuations, and I think the flow of liquidity into the markets have also been pretty high. At our end, I think we've been managing money with a long-term view on sectors and stocks, and we've been bottom-up in our approach to investing. So we've tried to avoid stocks where valuations are very excessive, but have remained invested in stocks where the runway of growth is fairly long, and companies and businesses which have been doing well, profitable, and run by good professionals. So those companies we stay invested, but at excessive valuations, obviously we'll have to take a call whether to reduce or to book out.
All right. Hi, Venugopal. Good morning and good to see you. When, there was a time of last year that people were very, very bullish on the mid-cap and the small-cap space. Then it appeared, they ran a little bit ahead of themselves. At current reckoning, what would the allocation strategy be? Because there are still plenty of good quality companies out there in the broader markets, but some of those stocks have ran up maybe way too ahead of themselves. So your take, between positioning as of now.
Yeah, good morning, Nigel. I think mid and small caps have done quite well over the last couple of years, and continues to outperform the large cap index. I think this is being driven by the overall construct of the economy and doing well, and the business cycle really into an expansion phase. And we've seen in the past also, whenever there is an expansion cycle in progress, these mid and small cap companies really do well. This is also getting a lot of tailwinds from the reforms that have taken place in the recent past. There's a shift away from the unorganized sector to the organized sector in many cases. So smaller companies having achieved scale are now growing faster, and that's the reason why you're seeing this trend of the mid and small caps in the broad market outperforming the large cap indices. I believe this trend is likely to continue. Our strategy remains the same, that we are bottom-up stock pickers, and we find better opportunities on the broad market side. I think the large caps are fairly well understood. There's absolutely no research arbitrage there. There are far more opportunities on the broad market side, given that growth is currently better and the outlook is also better on that side. So we remain invested in the mid and small cap part of the market, and we remain constructive on that end as well.
Absolutely. Venugopal, do you have a view on gold finance companies? Do you own them in your portfolio broadly without sort of naming names or going into details? If you can talk about the sector. Stocks are down 5-6%. In some of these large liquid names, sometimes opportunities arise when you have these sort of one-day large accidents. Or maybe, we've seen many of those because of a variety of reasons, not just in financials, but gold finance specifically, if you have any thoughts.
Yeah, I mean, I think so. We are not really significantly invested in the sector. though it is a space which has been growing and doing well for some time, especially the specialized companies in gold finance. I think they've done quite well in the past. Um, uh, Time and again, we've seen regulatory pressures on multiple sectors, and especially in the financial space, we've been hearing increased pressure and giving opportunities, as you said. Sometimes you get good opportunities to invest when these kind of news flow hits the market and there's general panic. I'm not sure whether that is the case here. There has been a flow of regulatory announcements and scrutiny on multiple parts of the financial space. So we'll have to wait and see. I guess the entire space is likely to be under little pressure with this kind of in this kind of an environment. I would stay clear of some of these or of the sector for the time being, just to get some clarity on the final outcomes.
What about the PSU pack? That's been, where the big money has been made. The touch me not has not really worked. If you participated in most PSUs, you'd have made money. Some of the low float ones, let's keep them out of the discussion. But some of the banking names, they have done very, very well. The capital goods themes as well have done pretty well out there. The defense names. What do you like, Venugopal, from this PSU pack? Because, in all probability, we get continuity. And some of those reforms, they get a tailwind. So your view?
Yes, we have been invested in some of these names, and especially the PSU banks. We've been overweight PSU banks versus the private sector banks. We've been more positive there. And selectively, the rest of the PSU space, including the engineering, capital goods, defense, etc., we've had some exposure there as well across different schemes. I think there is a re-rating in progress for the entire PSU pack, given that there is far more autonomy today. They are the leadership in many of these companies have been given or have been made more accountable for growth, and they are getting the opportunities to grow. So I guess there's a re-rating in progress. So we continue to be positive there, even though we are selective in our approach to investing, and not every stock will perform. So you have to be careful there. But I think there is a lot more steam there left.
Okay. Venugopal, so finally, I guess deploying incremental money is the challenge, considering where we are in terms of valuations and just how the whole play is. Incrementally, would you still go for a sector like, let's say, banks, or would you stick to areas that have worked? You spoke about PSUs, but largely speaking, the capital goods space, the capex side of the market, that's the one that's done really well. So would you add more money there? Or would you look at the unrun and the unloved stories like maybe large cap banks or even FMCG?
Yeah, I still like the capital goods engineering, the investment space broadly. And that includes the manufacturing side as well. I think that's a wide range of sectors within manufacturing. We like many of those. But I think the best bet for the next few years will be the discretionary consumption space. I think that space has not done too well, especially many parts of discretionary consumption have not done well over the last 1.5 to 2 years, and we keep hearing about this rural economy slowdown. But of late, I think there seems to be some bottoming out in progress. My sense is that in FY25 at some point, maybe in the second half of the year, especially if we get some more clarity on inflation and interest rate cuts, my sense is that discretionary consumption will take off. And to that extent, and given that we are an economy which is at about $2,200 per capita GDP and likely to really go to $5,000 per capita GDP by 2030, I think discretionary consumption is the space where there will be significant opportunities over the next 7-8 years. So that's the space that I would be watching out for over the next 6 to 8 months. As of now,
Got it.
there seems to be less visibility of a full-blown recovery.
Yeah.
But I think the commentary from the consumer staples company seems to suggest that
It
it's
is
bottomed out.
happening. Got it. Venugopal, we'll leave it there. Thank you very much. Very, very busy day with earnings. So we're going to hop across to the First Management. Thank you for joining us, though, and hope to see more of you here on CNBC TV 18. Canada Bank is